Hi, and welcome back to the Business Career College video series. In this video, we're going to look at a little bit of a complicated concept related to, again, taxation of life insurance. This is not something that you have to be familiar with if you're studying for the LLQP at this time. If you're studying for a financial planning course, then this is quite useful. But if you're just getting ready for LLQP and certainly for mutual funds, this is way beyond what you'd have to be aware of. What we're going to look at here is the 250% rule, or we sometimes call this the anti-dump-in rule, and you'll see why we call it that right away. Or sometimes it's referred to as the 7-year rule or the 10-year rule. It has a bunch of different names here. And the reason that we are concerned with this rule is because it does sort of restrict how we can deal with taxation of or how we can deal with dumping money into a life insurance policy. So this would be most applicable to a UL contract. And if you look at your UL contract, there's no effect on the contract for the first 7 years. So you've got a policy you take out here. Year 1, I don't care about this rule. Year 2, when my cash values, so this line here represents my cash values, have grown a little bit. Again, no big deal. Year 3, they've grown a little bit again. Year 4, they've grown a little bit again, and so on. We go to year 5, year 6, year 7. And it's really in year 7 that I have the first time that there's any kind of meaningful impact here. So let's say, just for the sake of argument, that in my universal life policy, I have a $10,000 cash surrender value here in year 7. There's no impact yet, but what this is going to mean, going forward from this point, we are going to have an impact. And the impact is going to happen not in year 8 or in year 9, but rather out here in year 10. So you look at the year 10 cash surrender value, and it can be no more than 250% of what it was in year 7. So you're always measuring this 3 years out. 250% of $10,000 is $25,000. So the maximum cash surrender value that our income tax rules allow here is $25,000. And then we're going to measure that again in year 8. So in year 8, let's say, just for the sake of argument, we've grown this thing up now to a $12,000 cash surrender value. We are once again going to apply that 250% test. That's $30,000. That doesn't apply to year 10 though. That applies to, as you might expect, year 11. And in year 11, my maximum cash surrender value then is going to be $30,000, and so on. It just keeps getting measured in every subsequent year. So year 9 would impact on year 12, and year 10 would impact on year 13, and so forth. And you're always doing this 250% test. It's a rule that doesn't get applied very often, and usually a policy that's been in force for a number of years and has a reasonable cash value is not going to run afoul of this rule. Where it is a concern, though, and quite rightly so, is if you have a minimum funded policy. That is, if in year 7 you've got just this tiny little cash value, if you've got this minimum funded guy where there's been no cash going into it, and let's say, just for the sake of argument, you only have $1,000 of cash value here, well, you're never going to have a really big cash value with this policy. You can see then your year 10 maximum would be, in this case, just $2,500. You've in some ways really reduced the effectiveness of your universal life insurance policy by not building a cash value earlier. I hope that helps. Even if you're just studying for LLQP, this might be useful information, but it's not something that's generally tested at the LLQP level. It's certainly not included in the design documents that indicate what's tested for the LLQP. But for financial planning courses, absolutely, this is something you'll have to be aware of. Thanks very much. I hope you've enjoyed this, and I hope it helps you to further understand the taxation of life insurance.